69th. Fine. Calculate inventory turnover ratio. Total sales is 2,20,000. Sales return 20,000. GP is given to be 50,000. Closing inventory is given to be 60,000. Excess of closing inventory over opening inventory 20,000. So these sums now, which we will be doing, will be related with the certain thing uh, about the closing inventory and opening inventory, right? Like it is given excess of closing inventory over opening inventory 20,000. It means closing inventory is excess over opening by 20,000. You have to understand and find out what is the, you can say, closing inventory is given to be 20,000. Since it is excess, right? Opening inventory, we know that closing inventory minus excess of closing inventory over opening inventory. So they have given you that 20,000 excess is there. So if you from closing inventory, it means closing inventory is 20,000 more than the opening inventory. So if I subtract 40 from 60,000, I subtract excess, that is 20,000. 40,000 will be the, you can say, the um, opening inventory. So opening inventory is 40,000. So these are not, it's not difficult, only you have to understand what is given in the statement. So in the statement, since it is given that inventory, closing inventory is more than 20,000, more than opening, it means the opening will be 20,000 less than the closing. So, you know, we've got opening as 40,000, closing as already given in the question as 60. So 40 plus 60 divided by 2, we get average inventory as 50,000, right? Now we know that COGS is equal to net sales minus GP, right? Because why are we applying this formula? We need COGS, we need average inventory for the ratio, inventory turnover ratio. So already sales are given 2,20,000 minus sale return. It will be 2 lakh. We know that net sales is total sales minus sales return. So 2,20,000 minus 20,000, it will be 2 lakhs. GP is given 50,000. So by subtracting net sales and GP, we can get a cost of goods sold or cost for revenue of good from revenue from operations. We call it COGS is equal to net sales minus GP. So we know that I've already told you net sales means sales minus sales return. 2,20,000 minus sales return is 20,000 minus GP, which is given in the question to be 50,000. So after subtracting net sales minus GP, I get 1,50,000, which is COGS or cost of goods sold. Now I can find the inventory turnover ratio easily. I have COGS, I've calculated, it came out to be 1,50,000. So inventory turnover ratio is COGS divided by average inventory. COGS is 1,50,000. Average inventory is 50,000, right? So if I divide 1,50,000 with 50,000, I get 3 times is the answer for inventory turnover ratio. Got it? So only the thing in this question was that opening inventory was not given, and it was given in the question that a closing inventory is excess of opening by 20,000. So using that concept, you had to find, you know, opening inventory. That was it. Otherwise, all information was direct. Now note, please note, closing inventory, if it is given, now the questions that will be related with the adjustment of closing and opening inventory only. Now, if it is given closing inventory is 2 times of the opening inventory, right? 2 times of the opening inventory. So if this is given 2 times means, you know that if opening inventory is X, then closing inventory is 2 times, it will be 2x, right? So these kind of you say concepts will be utilized while solving the sums. Then let's take up the second this thing. Closing inventory is 2 times more than that of opening inventory. 2 times more, not 2 times like the previous case, 2 times more. So if opening inventory is X, 2 times more will be plus 2x. So these kind of the kind of statements you've done in junior classes in maths in unitary method, that will be utilized now while solving these sums. Let's take up the next sum. Next illustration is COGS is equal to 2 lakhs. Inventory turnover ratio is given 8 times, right? inventory in the beginning is 1.5 times more than the inventory at the end. It means in the beginning, inventory is more than the inventory at the end. Calculate values of opening and closing inventory. So here, what is given? COGS is given, inventory turnover ratio is given, right? So with the help of these two, you can say items, COGS and inventory turnover ratio, can I find average inventory? I can find applying the formula, because first you find, average inventory, which will come out to be, the formula that I'll tell you the formula. Apply, just it's done here. 8 is equal to 2 lakh upon average inventory. Applying this, that inventory turnover ratio is equal to COGS upon average inventory. Inventory turnover ratio is given 8, COGS is given 2 lakhs, average inventory I can find, average inventory is equal to 2 lakh upon, you can say 8, average inventory comes out to be 25,000, right? So now we have average inventory. So we know that average inventory, which has come out to be 25,000, is equal to opening inventory plus closing inventory divided by 2. Now let's assume, since it is given in the question, inventory in the beginning is 1.5 times more than the inventory at the end. So if I'm taking closing inventory as X, so in opening inventory will be, as it is given in the question, 1.5 time more than the closing. If I'm taking closing as X, then opening inventory will be 1.5 times more than the closing. It would be X plus 1.5X, right? So this is, I told you, this many number of times more than this. So X plus that number of times that you will take. Now we have closing inventory as X, opening inventory as X plus 1.5. So I can find the, you can say, I can put it here, right? This 25,000, we've already calculated average inventory, right? From the information given, which I explained it to you. So 25,000 is equal to X plus 1.5X upon 2. X is for the, you can say, for the opening entry, of X is for the closing entry, X plus 1.5X is for the opening entry, right? Since it's given that the opening entry, the closing entry is, the opening entry is, inventory is 1.5 times more than the closing. So it would be X plus 1.5X divided by 2. If I, solve this, 2, I will take this side, 25,000 into 2, it will be 50,000. So this, if I solve X plus 1.5X will be 3.5X, right? I will add 1 plus 1 plus 1.5X. It will be 3.5X. So 3.5X is equal to 50,000. On solving, X would be 50,000 upon 3.5. That I know that you know how to solve. X will be 14,286. That X we took as the closing inventory. Now you calculate opening inventory. We've done that. Opening inventory was X plus 1.5X. X has come out to be 14,286 plus 1.5 into 14,286. The answer is coming out to be 35,750. So you can see that how in these sums only other information is directly given. How information related to inventory we need to find opening and closing inventory. Now let's take up the next sum. Next illustration is cost of revenue from operation is rupees 50,000. Credit revenue from operation is 1,50,000. So you have cost of revenue from operation, credit revenue from operation. GP is given 25% on cost. Closing inventory was 3 times the opening inventory, right? So it's simple. If opening inventory is say X and the closing inventory is 3 times the opening, it would be 3X, right? So opening inventory was 10% of cost of revenue from operations. So it means opening inventory is not given directly. Opening inventory, they've given you that opening inventory was 10% of cost of revenue from operations. So we need to find cost of revenue from operation is already given. So we need to find COGS. How we will find COGS? We will just see calculate inventory turnover ratio. Since they have given you cost of revenue from operations 50,000, right? But credit revenue from operations 1,50,000 and GP is 25% on cost. So this is the problem area. We've done a similar sum before also. GP 25% on cost. Whenever such thing is given, GP on cost, you have to use the unitary method. So let's take up that if GP is say, if say COGS is rupees 100, GP is 25, right? Because it is given in the question, 25% on cost. If cost or COGS is taken to be 100, then GP is 25. So then the revenue from operation means net sales will be, as I told you yesterday, I explained that what is a COGS plus GP is net sales, right? We've done the formula that net sales plus GP will give us COGS. Net sales, sorry, it is COGS is equal to net sales minus GP, right? Now I want to find net sales. So net sales will be using this formula. Net sales will be COGS plus GP. So I've assumed COGS to be 100. GP is 25. So net sales on revenue from operation will be 100 plus 25. It will be rupees 125, right? Now we'll write that if revenue from operation is rupees 125, then cost is 100, right? If revenue from operation is 2 lakhs, how we've got 2 lakhs revenue from operations? They've given you 50,000 is cash revenue from operations and 1,50,000 is the credit revenue from operations. So we've got both the sales, cash sales and credit sales in the question. So we know that total sales will be credit sales plus cash sales. So it will be 50,000 plus 1,50,000. So the total sales in the question are 2 lakhs. So we have now total sales or net sales is given in the, if revenue from operation is 2 lakh, then COGS will be equal to 2 lakh into 100 upon 125. That I explained you, unitary method, right? So it would be 2 lakh into 100 upon 125. It will come out to be, COGS will come out to be 1,60,000. Now it is given that opening inventory is 10% of COGS. So 10%, we've calculated COGS as 1,60,000. So opening inventory is 10% of COGS. So 10% of 1,60,000 will be 16,000. So direct opening inventory you can find directly. 10% of COGS is given in the question. So COGS has come out to be 1,60,000. So 10% of 1,60,000, the inventory is coming out to be 16,000, right? Now, if you see the question, I'm going back to the illustration. In the illustration, it is given that closing inventory is 3 times the opening inventory, right? So we've just now calculated. Yes, beta.
Suhana is not in the class.
Yes, who? What happened? Who's this? Suhana, what happened? Now you have, if closing inventory, it is given in the question that closing inventory is 3 times the opening inventory, right? Opening inventory is given to be 16,000. So 3 times opening inventory, it means 3 into 16,000. 3 into 16,000, it is coming out to be 48,000, right? So the average inventory is opening inventory plus closing inventory divided by 2. Opening 6 is, we calculated, it came out to be 16,000. Closing has come out 3 times of opening, which has come out to be 48,000. Divided by 2, it is coming out to be 32,000. So you can see that average inventory is 16,000 plus 48,000 divided by 2, it is 32,000. Now we have COGS also with us, which came out to by applying the, now as we know that inventory turnover ratio is COGS upon average inventory. COGS we calculated by applying unitary method. We applied let COGS be 100, GP is 25, then net sales is equal to 100 plus 25, 125. Then we calculated COGS is equal to the value of net sales in the question was 2 lakhs, 2 lakhs into 100 upon 125. We use the unitary method in order to calculate COGS. So by using the unitary method, the COGS value came out to be 1,60,000. Average inventory we just now calculated, it came out to be 32,000. So if I'm dividing 1,60,000 with 32,000, I'm getting the inventory turnover as ratio as 5 times. So these sums in this one main thing that we've learned, if this GP can be on sales, if it is on sales, it will be very easy to calculate, right? This is just a quick recap because this will be utilized in even in the next sum. So not in the next, yes, in the next sum also. So I did not take the next illustration. Same concept will be used. If, as I told you, if you remember, GP can be on net sales, GP can be on cost. If GP certain percentage, say 20%, 25% is given on net sales, the calculation is direct that you will calculate 25% of net sales. But if it is given on cost, then you have to, as I told you, you have to use unitary method where you have to assume cost as 100, GP 25, then net sales would be 100 plus 25, it will be 125, right? Then you will have to apply that if COGS is 100, if net sales is say 125, COGS is 100, then revenue from operation given in the question, whatever value given in this as the revenue from operation was 2 lakhs. So this way you can find if revenue from operation is 2 lakhs, then cost of goods sold will be 2 lakh into 100 upon 125. This is the main thing, right? Apart from that, the question, there's nothing, in the calculations. The application is almost direct. Then the other thing that I told you is about the inventory, three times, 3 times more than the opening. These kind of things will be given to you where you can have to find both the opening inventory and the closing inventory, right? So let's take up next time I'm leaving because it was about that only, similar to the previous one. COGS on cost, which I've already, told you. GP on cost, sorry, which I've already explained. So I'm taking the 73rd illustration. Let's see what is it. Calculate. Let me check. Yes. Calculate inventory turnover ratio. Opening inventory 20,000 is given in the sums. Purchases are given to be 1,60,000. Closing inventory is given to be 60,000. State with the reason which of the following would increase, decrease, or not change the ratio, right? So these are about the whether the ratio will change, not change, right, or will remain, decrease, increase, whatever. So now let's see. They have not given you the value of in this question, they've not given you value of inventory turnover ratio, right? It means you have to find what is inventory turnover ratio, the beginning value. So we know that inventory turnover ratio is equal to COGS, that is cost of revenue from operation, divided by average inventory. So they have given you COGS, they is not given directly. COGS, as we know, we have to apply this concept. COGS, we did yesterday also. We will use it in notes to accounts. You will write COGS is equal to opening inventory plus purchases minus closing inventory. Direct expenses are not there. I will ignore direct expenses. Opening inventory is given 20,000. Purchases are given 1,60,000. Closing inventory is given 60,000 minus 60,000. So I get COGS as 1,20,000. So I have to find average inventory now. Average inventory, opening, closing inventory, both are given in the question. Opening is given 20,000 and closing inventory is given 60,000. So I will find the average inventory, opening plus closing divided by 2. So 20,000 plus 60,000 divided by 2. I get average inventory as 40,000. So I will now divide both COGS and average inventory to find inventory turnover ratio. COGS came out to be 1,20,000. Inventory came out, average inventory came out to be 40,000. So now the ratio is coming 3 times, right? So in this question till now, we've been doing whether the ratio will increase, decrease, not change. Some value was given in the beginning, but in this case, the value is not given. We have to find it because the other information is given regarding COGS and average inventory, right? So now starting point is that the inventory turnover ratio is 3 times. We have to see by a transaction whether the ratio will either increase, decrease, or not change, right? Let's take up one by one the cases. The first case. So keep in mind the starting inventory turnover ratio is 3 times. Now sale of goods for 20,000, cost is 16,000. So what will be the impact? Sale of goods for 20,000, right? It means sale, due to sale of goods, closing inventory will reduce, right? So as we know, in COGS will increase. Why COGS will increase? Due to a decrease in closing inventory. Because if you know the formula of COGS, COGS is equal to opening inventory plus purchases minus closing inventory. It means if closing inventory is increasing due to sale of, if the closing inventory is decreasing due to sale of goods, then the amount to be subtracted will reduce. If amount to be subtracted will reduce, it means COGS will increase, right? So COGS will increase due to decrease in closing inventory, and every average inventory will decrease. Why? Because we know that average inventory is opening plus closing inventory divided by 2, right? If closing is decreasing due to sale of goods, of course, average numerator is decreasing. It means average inventory will decrease, right? So due to decrease, the reason is why average inventory will decrease due to decrease in closing inventory. Now we will find that how why the reason that we gave that COGS will increase and average will decrease, what will be the overall impact on the ratio is that the inventory turnover ratio will increase. How we have to calculate and show. Let's see. The opening inventory is 20,000 given in the question. I'm finding the average inventory. Average inventory is equal to opening, which is given 20,000, plus closing. Since there's a sale of 16,000, it means the earlier closing inventory was 60,000. So due to sales, as I told you, closing inventory will reduce. So 60,000 minus 16,000, closing inventory is 44,000. So the average inventory is 20,000 plus 44,000 divided by 2. Average inventory is coming out to be 32,000. Now I will find COGS. COGS opening inventory is directly given in the question, 20,000. Purchases is given 1,60,000. Now, but as I told you, closing inventory has reduced. It has reduced from 60,000 to 44,000 due to sale of goods worth 16,000. So I will subtract 44,000 to calculate COGS. So opening inventory plus net purchases minus closing stock, the or closing inventory on the COGS is coming out to be 1,36,000. So I will divide and see. I will find inventory turnover ratio 1,36,000 divided by 32,000. Now the value is coming out to be 4.25 times. Just see, earlier value was 3 times. Now the answer is coming 4.25 times. It means inventory turnover ratio has increased, right? So by reason I've already explained, due to sale of goods, COGS will increase. Why will COGS increase? Due to decrease in closing stock. Average inventory will decrease. Why average inventory will decrease? We've just now seen that average inventory decrease due to decrease in closing stock, right? Let's take up the next case. Increase in value of closing inventory by 20,000, right? It means the closing value, the inventory has increased by 20,000. So it means uh, inventory turnover ratio will decrease. How? Let's see why I'm saying that inventory turnover ratio will decrease due to increase in value of inventory by 20,000. Fine. So in the beginning already opening inventory is given 20,000, net purchases are given 1,60,000. And if you remember, closing inventory was given as 60,000. So it means in the question, it has in this part, it has increased by 20. It means from 60, closing inventory has become 80. 60 plus 20,000, it will be 80,000 now. So new COGS will be COGS is equal to 20,000 plus 1,60,000 minus 80,000. So COGS have become 1 lakh, right? Just see the previous COG was here. COGS was 1,20,000. With increase in closing inventory, it has become 1 lakh. So you will say that COGS have reduced due to increase in closing inventory, right? Now the average inventory, let's take, I have to, instead of 60,000, I have to take closing inventory as 80,000 as given in the part that the closing inventory has increased. So average inventory is 20,000 plus 80,000 divided by 2, 50,000. Just see again, if I compare with the original value, average inventory was 40,000. Now the average inventory has increased from 40,000 to 50,000. Why it has increased? Because the closing stock has increased, right? Now I will find inventory turnover ratio, 1 lakh, which is COGS, divided by average inventory, which is 50,000. So 1 lakh divided by 50,000, it will be 2 times. So you just see the starting value of of the inventory turnover ratio was 3 times. Now the ratio of inventory turnover ratio, the value is 2 times. So it has reduced, right? So let's take up next. So the two previous cases we did, first case we did stock decreased, then inventory turnover ratio increased, and the second case that we took was stock, it increased, so the inventory turnover ratio decreased. Now let's take up the next thing. Goods purchased for 40,000, right? Inventory turnover ratio will decrease. Let's see. Again, purchase for 40,000 means if goods purchased for 40,000, closing stock will increase. Purchases will increase, right? But there will be even closing stock will increase. So what will be the net change? COGS will not change. One item is added, one item is subtracted, right? Increase in both closing inventory and purchases. As we know, purchases are added, closing inventory is subtracted. So net effect will be no effect, no change in COGS. COGS will not change due to goods purchased for 40,000, right? And now let's see the effect on average inventory. Since average inventory consists of both opening and closing inventory, as the goods are purchased for 40,000, if closing inventory was 60,000, now the closing inventory will become 1 lakh. 60,000 plus 40,000, it will become 1 lakh. So we know that the opening inventory is 20,000. Now the closing inventory has increased from 60 to 40,000 due to goods purchased for 40,000. So to 20,000 plus 1 lakh divided by 2, the average inventory is coming out to be 60,000. Now I will find inventory turnover ratio. As we did, COGS will not change. Initial COGS was 1,20,000. So COGS will remain 1,20,000 only, because I already told you why COGS will not change. Purchases will increase, and closing stock will, you can say, will also increase. So plus minus over effect is no change. So, but I'm dividing it with average inventory, which is 60,000. So 1,20,000 divided by 60,000, it is coming, the answer is coming 2 times. So you can see that the inventory has decreased, right? Let's take up next. Purchase return 10,000. So we will see that inventory turnover ratio will increase. How inventory turnover ratio will increase? Let's see. Purchase return 10,000. Now purchase return. So same effect, if there's a purchase return, COGS will not change, right? As purchase return will, decrease purchase and will increase closing stock, right? So since one is increasing and the other is decreasing, overall impact is that the COGS will not change. So there'll be no change in COGS due to purchase return, as there's a similar equal amount of change between, you can say, due to purchase return between purchase and closing stock. You know, purchase return is subtracted from purchases, so purchase will decrease, and due to purchase return, closing stock will increase. So net impact is no change in COGS. Now let's see what will be the change of purchase return worth 10,000 on, you can say, on this thing, average inventory in like 20,000 plus 50,000 due to purchase return, plus divided by 2, it will be 35,000. Now I will inventory turnover ratio 1,20,000 divided by, you can say, closing stock, that is 35,000. So it is coming 3.43 times. So it is increasing. So you can say that the inventory turnover ratio will increase due to purchase return 10,000, because purchase return will, you can say, will decrease purchases, right? And it will also decrease, you can say, closing stock by the same amount. Fine. So the both purchase return will be, I think so, should, it's not given. I will check this. It's given in the book, right? We will discuss this again. Tomorrow, I will be taking your period of Chaitali ma'am. Chaitali ma'am's mother, she's gone out to meet her mother, is not well, right? So I will check up this part. I know there are a lot of mistakes in the book also. So I will check and we will discuss this part again. I'm not convinced with the solution, right? So don't worry. I will be explaining this part again. Uh, let's see. Uh, now next is, please girls, now you please bring your books. I'm waiting, right? You, or should we discuss tomorrow? Fine, we'll discuss tomorrow. Tomorrow you bring your books. We will discuss two problems, because, or you can, if you want to bring your books, you can. It's very easy. How to, you can open up your books. If you've already opened up, let's do the next illustration. I will tell you. 75th illustration. You check the number in your books, right? It is related with balance sheet. If the extract of balance sheet is given to you, how will you collect the information from the balance sheet? Let's see. Question number 75th. Please open it. I've left the first balance sheet. It's direct, right? 75th. Okay. I've left that question. You do 74th. We've done a lot of similar, treatment of opening inventory, closing inventory. That is, we've done. So please come on to illustration where the extract of balance sheet is given. All of you open. Okay. I will ask you, we have to find in the question, since the extract is given, so it means we have to find the information ourselves. If you remember, I told you, when extract of, you can say, profit and loss is, it's not balance sheet, it's profit and loss extract given to you. So if a statement of profit and loss is given to you, how do you find COGS? The formula, if you remember, yesterday we discussed, and I emphasized that this is a new formula which you need to learn for cost of goods sold. Cost of goods sold would be purchase of stock in trade plus, you can see, purchase of stock in trade is given to you. Purchase of stock in trade is given to you is 1,20,000. See in the statement of profit and loss, against purchase of stock in trade, they have given you 1,20,000, right? The second item is change in inventory of stock in trade. So you can see the second item under expenses, change in inventory of stock in trade, 30,000 is given to you, right? But you go down, change in inventory of stock in trade, you go down, and change in inventory of stock in trade is given to be 20,000, right? So we write 20,000. Then comes down direct expenses. Can anyone tell me, are direct expenses given? I told you how to find direct expenses. I told you yesterday, either employee benefit expenses, under that you will find, you can say, direct expenses. Other place where you will find direct expenses is under other expenses. Since in the question employee benefit expenses are not given, where will you find direct expenses? Can anyone tell me which is a direct expense in the
No
question?
account.
Which is a direct expense? Anyone?
Carriage inwards.
Yes, you have to know, since I told you employee benefit expense is not given details. We have to go down and see in notes to accounts, but other expenses are given. In notes to accounts, you go down and see carriage inward is there, carriage outward is there, miscellaneous expenses are there. So carriage out of these, carriage inward worth 10,000 is a direct expense. right? So plus 10,000 I've written, right? So it is from this COGS will be purchase of stock in trade plus change in inventory of stock in trade plus direct expense. It will be 1,50,000. So depending on the extract of statement of profit and loss, we have to see which item fits, which helps in finding COGS. So if you take the simple, direct expense, I've already told you carriage inward. So now average inventory, I will first explain and then I'll come back to the point. Average inventory, how will you find average? Opening plus closing inventory divided by 2. So if you go down and see in notes to accounts, opening inventory less closing inventory of stock in trade is given to you, right? 40,000 and 20,000. If you see in notes to accounts, so you can get from there opening inventory of stock is 40,000, closing inventory is 20,000, directly given in notes to accounts, right? So 40 plus 20 divided by 2, average inventory will come out to be 30,000, right? So this I've already told you. So inventory turnover ratio, COGS divided by average inventory. COGS we calculated out, it came out to be 1,50,000 divided by 30,000 5 times, right? So I told you the other formula for COGS, when statement of profit and loss is given, you have to take, as we know in statement of profit and loss, we have the everything purchases of raw material in the form of, you can say, purchase of stock in trade. That, so you will take all those items and finished goods and work in progress. So here we don't have simple opening minus closing inventory plus purchases or direct expenses. We have the opening closing inventory sometimes of all the items here, of the raw material, of the stock in trade, finished goods, then you have the even the work in progress. So you have to learn COGS as we did yesterday, that the formula for COGS will be different when we will be preparing statement of profit and loss according to Schedule 3 of Companies Act 2013. That is the only formula you need to learn by heart, right? Because I know the items are new. Now let's take up one more similar sum quickly, related with when statement of profit and loss is given to you, how to identify the items which will be considered under COGS and which will, what item will be considered as opening inventory and closing inventory, right? Let's see. Come on to again the extract of statement of profit and loss of Renault Limited, calculate inventory turnover ratio. So we did, let's see what all is given. I told you the formula for COGS is cost of material consumed. Cost of material consumed is given to be 5,25,000, right? Let's see change in inventory of finished goods. See, are finished goods given? uh, Change in inventory of finished goods and work in progress is given together. It is given both of finished goods and work in progress. Negative value is given. It is given in brackets minus 25,000. So I will subtract from 5,25,000 minus 25,000. So COGS is coming out to be 5 lakhs. So I hope it is given. It is given in 5,25,000. Cost of material consumed is directly given. Now, as I told you, both of finished goods and work in progress, total value, negative value 25,000 is given. So I've subtracted 25,000 from 5,25,000. I'm getting COGS as 5 lakh, right? Now, how to find average inventory? Go down and see what all opening closing inventories of what items are given. In this case, opening closing inventory of both cost of material consumed and change in inventory of finished goods and work in progress, all the opening closing inventory of everything is given. So we have now 4 items related, 2 items related with opening inventory of materials and opening inventory of finished goods and work in progress. So just see, opening inventory of material consumed is 2 lakh, work in progress is 50,000. So see, two values are given, 2 lakh plus 50,000. Now we have two values for closing inventory, because closing inventory of materials is given 1 lakh and closing inventory for work in progress is given to be 75,000, right? Just see in the book. So we have again two values related with closing inventory. 1 lakh is for cost of material consumed closing inventory and 75,000 is the closing inventory of finished goods and work in progress. So here So every time when you have to find opening and closing inventory, you to go down in notes to accounts to see who's, as I told you, all will be considered. Cost of material consumed consists of raw material, finished goods will consist of finished goods, work in progress will consist of work in progress. So there are three main items which will be considered for COGS. Cost of material consumed. If you remember first chapter, it is about raw material, then finished goods, inventory of or purchase of finished goods, stock of finished goods. That will be the second head, and third will be work in progress, right? So as I told you in the question, there are two opening inventories, two closing inventories of two different heads. So 2 lakh plus 50,000 plus 1 lakh plus 75,000 divided by 2, average inventory is coming out to be 2 lakh 12,000. Now inventory turnover ratio COGS we calculated out, it was 5 lakh. Average inventory is 2 lakh 12,500. So if I divide, I get the answer 2.35 times, right? So you continue, I'll upload the videos, you see them, and in summer vacations you solve the sums. So I've given you one more than a month to solve it, right? Please solve and come, don't waste your summer vacations, right? Thank you, thanks for joining, and we'll